Good evening, everyone. So this is our 9th seminar in our series. It's also our last seminar in our series. So I know a lot of you guys have been coming every single week since the beginning. So thanks for coming every single week, and I hope you've enjoyed the series. We are ending it by talking about exits, and Basil Peters is here to take you through that topic. Here you go.
Thanks, Angie. Good evening, ladies and gentlemen. Congratulations on making it to the final seminar in the New Ventures BC series for 2010. I'm going to try and convince you that for your ventures, you should start at the end by, at the very beginning, thinking about your exit strategy. Just before I start off, I want to make it clear that I was a technology entrepreneur, and now I'm a tech exit strategist. So my comments come from a technology background. And I want to admit up front that there are some things about financing and exiting life sciences companies and energy companies that are a little different. But I'm a tech guy. And I'm not going to be talking tonight about public market financial strategies because those really aren't a viable option today. I hope they will be again soon, but this is about what's going on today in the markets. I want to start off by congratulating those of you who are entrepreneurs. I think for the few of us who can, it's by far the best life and business choice. And so I'd like to start by having you ask yourself, why are you doing this? Seriously. Entrepreneurs have very complex motivations. And I didn't know when I was an entrepreneur, but I hope you're doing better than I was, and you can maybe get some perspective on the extent to which you are being an entrepreneur because you can't get a real job, or because it's the most exciting thing you can think of, that's legal anyway, or because you like learning so fast it's going to make your head explode most days, or because you're doing it to make a truly huge amount of money. And for most of us, of course, it's going to be a combination of those. But the reason I would like you to think about that question is that for investors, because I'm also an angel investor, it's quite different. We're very simple creatures compared to entrepreneurs. And so we're simple to deal with if you understand how we think. And what I want you to appreciate is that from an investor's perspective, this is how we think of your company. It's a black box. There's two inputs, some sweat equity from you, some capital from us. We want you to turn the crank on the side so that it spits out some capital gains. That's our whole world, us investors. The truth about investors is we are a pain. And we're going to want a lot of documentation. We're going to want financial reports. We're going to want board meetings. We're going to want to help, which, quite frankly, most of the time is not a good thing. And we want to get our money back. And that's why, to be able to deal with us, I think you've got to have an exit strategy long before you come and talk to the investors. In my opinion, I think exits are the best part of being an entrepreneur or an investor. It's when we get paid for all the hard work we've done and all of our risk capital. It's also the least well understood part of being an entrepreneur, simply because it doesn't happen very often. So my goal this evening is to provide some information to help you design and execute better exits for your companies. It's surprising how much of what you hear about exits is wrong. Lots of it is dangerously wrong. There are so many myths and misperceptions, and so many experts, in quotation marks. And there's quite a few dirty secrets. And it's all compounded by the fact that the economy has been changing a lot. So this seminar tonight is about what actually works today in 2010 in our current economy. There are basically two ways to sell your company: through an IPO, or going public, and through an M&A transaction, or a private sale. These days, for all intents and purposes, it's all about the M&A option. That's how companies are going to exit, if they're going to exit in this year or at least the next couple of years. It might change in 13 or 14, but for now, the game is M&A exits. So what happened to those big IPOs? Well, it's not been just for the last few years since the mortgage crisis. There have actually been very few venture-backed IPOs since the tech bubble burst in 2000. And it's not likely that the IPO market in America is going to come back until Sarbanes-Oxley is either repealed or modified. And even though there's a lot of work going on Capitol Hill right now, that's not looking like an immediate change. And once it does happen in America, it'll still take a while for it to come across the border and make a difference in our local capital markets. So what about the big M&A exits? The media kind of distorts our perception because they're always writing about what we want to read about, which is the really big exits, the deals like YouTube and Skype. And the dirty secret is that those huge transactions rarely work out well for the buyers. The guys who bought YouTube are embarrassed. The guys, they probably paid $1 billion too much, and now everybody knows. And a lot of times when you see those really big transactions that are certainly exciting, they haven't been good deals for the people who bought them. And so corporate America today is kind of figuring that out. And very few CEOs now are going to their boards with billion-dollar deals unless they're really, really sure they're going to work. So the huge M&A exits aren't happening as often anymore either. So it's human nature to get excited about things like, Club Penguin's $350 million sale to Disney, or the Customs House sale in Victoria for $370 million. But the really big story, what's important to more people, what's important to most of us, is the really large number of small exits that are happening right now. I spent a little bit of money and far too much time in the MergerStat database trying to find out just how big M&A exits really are. And the challenge with trying to understand that market is that the databases you can buy always have this little footnote that says when the price is disclosed. And when the price is disclosed, it's easy to see that the median price is under 20 million. But I'm pretty sure that the median price is under 15 million. So what that means is that half the time when a company gets sold, it gets sold for less than $15 million. And that's a much smaller number than I would have thought before I started to do this research, because our perception is distorted by the media and all these really big stories that stick in our minds. But the reality is, if you're building a company today, the odds are you're going to sell it for less than $15 million. And that's a good thing. I went out to try and understand better why this was happening, because this hasn't always been the case. This wasn't the nature of the M&A market back when I was actually running and building my own first company. And I've got a friend who has been working in a Fortune 500 company, running a big sort of billion-dollar division, and he explained it to me this way. He said that the big companies know that they aren't good at new ideas or startups. He went on to say that they know that they basically suck at building businesses from $0 to $20 million in value. But he went on to say that they think of themselves as being really good at growing businesses from about $10, $20, $30 million in value to $100, $200, $300 million in value. That's what big companies know is their core competency. That's what they're good at. That's how they can make money for their shareholders. And my friend went on to say that when a company gets to be worth $100 million, it's already out of their sweet spot. And he works for a really big company. And he also said that, $100 million transactions require board approval. And he went on to say that that means that his boss, the CEO, wants to help. And he had this look on his face. It's the same look that people have when they say that the government is here because they want to help. So it didn't look like it was a good thing from his perspective. So what he said was that at $20 million, it just takes one more signature to get a deal done, the CFO. And if he could, he would buy a company every month for $20 million. And he would if he could have found enough of them to buy. If you look at these big companies' financial statements, many of them, most of them, are spending more money on acquisitions than on R&D. Because it's the best way for them to grow. It's far better for them to wait to see something that's a success and then to write a big check. That's what works for them. It's also what their shareholders want. I was really surprised just a little while ago, a few months ago actually, to hear an online webinar from one of the top guys at Google who buys companies, Charles Rimm is one of the top 5 guys in the world in Google. His job, and the guys that report to him's job, is to buy companies just like the ones that some of you are probably building. And Charles said, this is an actual quote, that 90% of our transactions are small transactions. Less than 20 people, less than 20 million. And that is truly the sweet spot. So he's saying exactly what those statistics said, exactly what my friend said, that what Google wants is things worth $20 million. That's sort of the target in their mind. And keep in mind, Google is one of the biggest companies in the world now. He went on to say that they actually prefer companies that are pre-revenue, which is a really surprising statement. And I think what he means there is not companies that have no revenue literally. I think what he means is pre-appreciable revenue, like, sort of under $1 million in size. So what Charles Rimm is saying is, build your company up to, 10, 20 people, maybe $1 million in revenue. That's when we want to buy it most. I've got that whole interview up on my blog if you want to listen to it, and the whole webinar is available from the Quorum guys in Seattle who hosted the webinar. But it's absolutely fascinating. If you want to find out what it looks like from the other side of the table in M&A transactions today, you can hear it from one of the best. The other thing that's fascinating out there and is incredibly good news for entrepreneurs is that big companies have a lot of cash. So much cash that it's a problem for them. Their shareholders are complaining. They're saying, look, either spend it on something that's going to make the company bigger or give it to us. Dividend it out. I spent about 10 minutes one Saturday morning looking at just how much cash these companies had. Google's got about 20 billion, eBay's got 5, Amazon's got 3, Yahoo's got 3, Microsoft has 35, and Apple has $25 billion. I mean, truly enormous amounts of cash just sitting there on their balance sheets, earning like 1% interest today, real interest rates in America. So this is a huge war chest, and it's starting to move now very quickly as these companies are almost, again, in a feeding frenzy to buy young $10, $20 million startups. And it's these big companies, the Fortune 500, are always the ones that we hear about because, again, the media connects us with the big stories. But there's lots of other buyers out there. There are thousands of medium-sized companies, especially the public ones, that are also aggressive buyers. The private equity funds, which is a kind of a fund like a venture capital fund, but they buy whole companies. These guys had been on the sidelines for the last 2 or so years due to the mortgage crisis. Well, now that the American TARP money is starting to flow into the ecosystem, that money is flushing all the way across the border. And these private equity funds are back in business with a vengeance. And in the last 3 or 4 months, we're actually starting to see prices for acquisitions go up because there's so much money out there that wants to buy companies today. There's also a large number of just individuals, guys that are sort of my age. They've grown a couple of companies. They've got a little bit of money, several $1 million, but they're not ready to retire. They still want to do something more. They've got friends who have money. Lots of people that are sort of my age and a little bit older are just going out there and buying another company. And that's what they think they want to do to make another few $1 million between now and when they get serious about their golf game. There are tens of thousands of guys out there right now wanting to buy companies in that $10, $20, $30 million range. So today in the 21st century, about a decade in, what seems to be working is that small companies are the ones that are creating the innovations. Angel investors and friends and family investors are financing them. Big companies and a large number of others are buying them early, and then they want to grow these businesses farther. And the entrepreneurs and the investors in the small companies are recycling their gains. That's kind of the snapshot of the engine that's driving the North American economy today. One of the things that comes up often in these talks that I give is somebody will say, well, how big does my company have to be before I can sell it? This is kind of a surprise that it's happening this early and at these small numbers. What determines when you can sell? Well, it's a common misunderstanding about M&A exits that you've got to grow the company to be profitable. I've heard that more times than I've heard the truth, because that's what people perceive to be the reality. Or often you'll hear that to be able to be a target for an M&A exit, you've got to be bigger than X million, $10, $20, $50 million. The real threshold is just to prove the business model. Let me tell you what that means. And it's different for different types of companies. But let's take, for example, a recurring revenue business. A business is where you've got customers paying you a certain amount of money every month, just for example. And when you can get to the point where you know what the gross margin is per customer, and you know how long that customer is likely to be a customer of yours. In other words, you know how long that client's going to be writing that $10 or $20 check every month. And when you can actually calculate what it costs to acquire a customer, which is the hardest part on that list, knowing what your real sales and marketing costs are to acquire customers, when you can get to that point, that's when you can prove the model. When you can answer the simple question of, what's a customer worth and what do they cost to acquire? When you can get to that point, you can go out and have a discussion with a bigger company and say, look, if you buy our company and then you add X million dollars more capital, you'll end up with Y more customers, and that makes the business worth Z million dollars more. That's all you've got to be able to do to have a discussion with a qualified buyer and to negotiate a successful exit. And that's, sometimes there are other factors. Sometimes there are different types of companies where you've got to think about the selling price and other things like that. But that's the threshold that actually determines when you can sell the company. And lots of times it's well before the first $1 million in revenue. And it's most often well before the company is actually profitable. Because if the company's growing fast, the fundamentals can be there, the model can work, but you're still spending more on growth than you're actually delivering to the bottom line. That's all you've got to do to be able to negotiate your exit and to sell the business. It's also often the best time to sell the company. It's always better to sell on an upward trend, to sell on the promise rather than the reality. It's often when you can get the best price. And very often in business, as I've learned many times, and I'm sure some of you have learned quite a few times as well, stuff happens. And in my business experience, that stuff is never good. And so the longer you're in the business, the more chance there is that something's going to go wrong. Some competitor's going to come in, somebody's going to find out you're infringing somebody's patent, your chief technology guy who you can't live without decides he's going to start a church. Something's likely to happen that's going to make that business not as great as it was just a little while before. And the sad truth is that most entrepreneurs end up riding it over the top. I did. I admit it. That was what I did in my first company, and I've done it a couple times since just to remember what it feels like. But most of the time, what happens is that entrepreneurs are having so much fun when their companies are growing fast. You know, the model's working, you're hiring people, people are writing magazine stories about you, you're winning awards. It's just human nature not to think about selling when everything is going that well. And usually what happens is that entrepreneurs and their boards wait until it's pretty clear that the company's best days are behind it. Just sort of on the other side of the peak and the curve. And then they say, hey, we should sell the company. The problem is that there's a lag time, 6 to 18 months after the time that you engage some professionals before the deal actually gets done. So what always happens is by the time the serious negotiations start, it's clear to everyone that the company's best days are behind it. And you usually end up getting a much smaller price than you could have if only you started the exit somewhere in here and gotten it done somewhere closer to the peak. And one of the reasons that this is such a heartbreaking process is that very often you could have sold the business here and not spent this 3 or 4 or 5 years of your life watching your net worth go down. And again, that is what happens most of the time, because it's very hard to really have the discipline and to know when you really should start that process. And I'm going to show you it's probably a lot earlier than you think. The internet has accelerated everything. And you as entrepreneurs know that you can market and sell to hundreds of millions of prospects in just days. Anybody with a credit card can get a Google AdWords account. You can be online and having literally hundreds of thousands of impressions in days. And the internet has also accelerated almost every other part of the corporate life cycle. You know, back when I was an entrepreneur and you wanted to hire somebody, you'd hire a headhunter and you'd wait a couple of months. They'd send you a bunch of resumes in the mail. You'd read them, mark them up, nail them back, and then after a while you'd get on an airplane and you'd fly to Toronto, and maybe 6 months later you'd have hired somebody. The last company that I was an investor in, I even can't believe this. One of the other investors put an ad up on Craigslist, hired a guy like 3 days later. Turned out I even knew the guy, but I just hadn't gotten around to going through my database, but he was already on board long before I even remembered that this guy who I knew well was looking for a job. Everything has changed. Everything is moving so much faster than it did before. I'm sure lots of you have heard the term weekender, where some entrepreneurs get together, conceive of a business model, build the entire business, and get it operational in one weekend. That's the goal. And when I wrote my book, Early Exits, last year, I speculated that one day they'll probably define an early exit as selling the company before the end of the weekender. That almost happened last year. In November, some crazy guys in London built a company in one day, and they sold it 10 days later on eBay. And it only took a day to build the company, but it took 9 days for the auction price to get to the point where they wanted to say yes. And these guys have got a great video up on their website. The video is only 3 minutes because they edited it quite a bit, but it's a really fun video to watch how these guys built a business in one day and sold it in 10. And that was, you know, they probably designed that. Maybe it was a bit of a stunt. But it's not an isolated example. I'm sure lots of you know what Flippa is. You know, Flippa is like an online market where you can sell and buy companies. And there are some other guys who coach entrepreneurs on internet companies, a thing called the 30-day challenge. And in the 30-day challenge, the goal is to build a company in 30 days, much more reasonable time frame. But around 20 days in, they say that if you aren't having fun or if it doesn't look like a winner, put it up on Flippa and sell it. So an amazing compression in the time scale. You know, in the old days, after 20 years, if it wasn't working, you'd sell it. Now, after 20 days, if it's not working, you sell it to somebody else. Let me give you some examples. And I will admit, before I show you these, I have selected these to make my point. They are maybe not typical, but they are nevertheless, I think, good illustrations. Here in Vancouver, Flickr sold for $30 million when it was a year and a half old. We all know that story. Delicious, which lots of us use, got bought for $30 million when it was 2 years from startup. Club Penguin, which none of us have not heard about because we live in BC, was a $350 million sale in a 2-year-old company. YouTube sold for $1.6 billion when it was 2 years old. Playfish sold for $275 million when it was 2 years old. Mint just sold for $170 million. It was 3 years old. And AdMob sold for $750 million when it was 3.5 years old. It's amazing how fast you can build and exit companies today, even at these kinds of huge values. And I'm not suggesting you can do that. These are certainly, you know, outliers, and there was probably some significant luck involved. But it does show you that, you know, 2 or 3 years is plenty of time to make the business work and to sell it. So now that you're seeing what's happening out there in the actual economy, I'd like you to ask yourself, you know, whether you even need investors. And I think that 100 years from now, when they're writing history about the early part of the 21st century, it's likely they're going to call it a golden era for entrepreneurs. And I'm serious. You're supposed to be laughing. I guess it's late in the day. Okay, good. Thank you. But you know, there's never been a time when there were so many huge opportunities and entrepreneurs could build such valuable companies on such small amounts of capital and sell them so early for so much. So it's hard to tell when you're in one of these golden eras. But this is a time, probably like there's never been before, to make money if you're an entrepreneur. And it's all because of the internet. You know, back when I was a young entrepreneur in the 80s, which, yeah, I know was a long time ago, companies all cost tens of millions of dollars to build. It didn't seem to matter back in the 80s whether you were building a hardware company or a software company. Everything cost tens of millions of dollars to build. And that's what created these enormous pools of venture capital that we still hear so much about. You know, these guys in Sand Hill Road down in Silicon Valley, or the big funds here in Vancouver. They are a legacy of an earlier time when companies needed all that capital. But you, as more modern entrepreneurs, know what a mashup is. And sometimes when I give this presentation to investors, I get a bunch of blank stares because they don't understand what's happened out there in the development cycle. But you know, with this huge open source world that we live in, we can build valuable companies for tens of thousands or maybe hundreds of thousands of dollars. And lots of these companies, even Club Penguin was started with no investors. They didn't need any money. It was a mashup. They just took a bunch of stuff that was fairly available, new development tools for rapid development of online cartoon-like games. Lots of these companies, Plenty of Fish, another great example. That company is probably worth $100 million. Marcus and his girlfriend started it in their apartment. And so the world has changed. Metro Lyrics is one I think you're going to be hearing about, a great startup out of Simon Fraser, fourth year, still undergrad. You've probably all heard about. No capital. That's probably worth tens of millions of dollars, maybe more. So the world has changed, and you as entrepreneurs actually have resources, even if you don't have any money. And what I think is, for all of you, even though I am an investor, my wish, my hope for you is that you bootstrap. If you possibly can, avoid raising capital. Remember that slide about the investors being a pain? We are. And it is the truth that if you look at the really great companies that have been built and exited, the greatest of them, the most efficient, the most spectacular, rarely had any outside investors. Maybe some friends and family money, but that's probably as far as most of them go today. Now, there are some business models that just can't be bootstrapped, especially if you get into things like life science and energy companies, like I said before. If you've got one of those kind of companies, then this isn't quite the story that you should be following. You are going to need some capital. There are some slightly different strategies. But most companies today don't really need very much capital. So if you really can't bootstrap, what are your options? You know, I know you sat here and watched Tanner from my old fund talk about venture capital, and I know you've heard from Mike Volker about angel capital. But, you know, what are your options really? Well, let me ask a question. How many of you think you're going to raise venture capital for your startup? That's more than last time. Last year I asked, nobody put up their hand. You know, how many are planning on angel investment? That's similar. Before I tell you what the answer is, again, statistically for most of you, some definitions. The type of financing we're talking about is private equity. And very many people use venture capital to define everything in this sphere. And small v, small c venture capital does include angel investors, friends and family investors, and venture capital funds. So I want to make a distinction when I say venture capital. I'm talking about capital V, capital C, the proper noun that is venture capital funds. So these are funds like in our town, Yaletown, Ventures West, GrowthWorks. Funds that have managers, that have offices, that have usually $100 or several $100 million under management. That's capital V, capital C, venture capital. Angel investors are guys like Mike Volker and myself sometimes, just wealthy individuals, people who write checks using their own money. The biggest difference between venture capital and angel investors is that the venture capital funds are investing other people's money. They're sort of middlemen. They pull the money together and then they invest it in the companies. Angel investors made that money and then they're investing it. The really big surprise, just the last few years in that private equity space, was just how big friends and family investors are. It turns out that friends and family investors invest 5 to 6 times more money than either venture capital funds or angel investors. It was a huge shock to me to realize that. So if you're looking for where most of the money is to fund your company, it's with your friends and family. That's the most likely place. That's where the big money is in the economy for new company financing. So who actually does finance startups? You know, when I used to get half the people in the room saying they were going to get a venture capital fund to fund their startup. Let me tell you what the answer is, and then let me get the question in the back. The actual data is that angel investors fund about 27 times more startups than VCs. So the truth is, you know, if you've got a startup and you're thinking that you might get some money from a venture capital fund, it's possible. You know, every year in America, about 400 or 500 companies startup companies get funded by VCs, and about 50,000 companies get funded by angel investors. Is there a question, comment, heckling?
No, I had a question. The question was, I wanted you, if you could comment on how important financing from older, more sophisticated channel partners might be. So you have an early stage company that's dealing with some reseller or channel partner. How often are they investors in a company?
It's a great question. And in earlier times, most big U.S. tech companies had venture capital funds. It was in the 80s and into the sort of early 90s. They all did. And I often pitched my company to captive venture capital funds of corporations. Today, the only significant one that I know that's left is Intel Capital. And it's fascinating, and it's a great question, because what has happened is that these companies all thought that it would be a good business model to have captive venture capital funds. They all had them. Lots of guys got financed by them. And TELUS, by the way, one of the previous sponsors of this very program, had a very well-known local venture capital fund. It still exists because they've got some investments in it, but they're not writing new checks. And so what these big companies found out was that they weren't very good at running venture capital investments. They found out that they're far better acquirers than they are investors. So while it still does happen, and I still have seen strategic investments happen, it's a very rare event. And if in the statistical sense, chasing strategic investment is really a long shot. In some cases, it makes the most sense. There are some companies, some business models, some industry niches where that's the thing to do. But by and large, you'd be better off going to a different place in their corporate directory and clicking on the corporate development, or really, I want to sell my company to you division, because it's much more likely they buy the whole thing than it is make a small investment, just because they found that works better for them. If you're interested in some of the statistics on this, there's a post on my blog that gets a huge amount of traffic where I talk about the statistics on why angel investors are far more likely to fund a startup than traditional venture capital funds. To give you a rough idea of the size, and it's unfortunate that in Canada we don't have as good a data as they have in the US. But you can take the Canadian numbers are roughly 10% of the American numbers. It's the best data we've got. In America, venture capital funds invest about $20 billion a year. Last year was a little bit less. Angel investors invest about the same. Last year was about 18 for angels and about 15 for VCs, if I remember correctly. But those are roughly the numbers. So here in Canada, think of it as about $1.5 billion from the VC funds, dropping quickly, and about the same from angel investors, but rising fairly steadily. And as I said before, friends and family are about 5 to maybe as much as 10 times. I think it's 5 or 6 times more than that. So that's where the real money is, and that's the reference to that work. It's fairly new. That's a 2009 reference, and the guy who wrote that, Scott Shane, is a university professor. Startling data when he actually found out where the money comes from that funds our companies, our tech companies today. One of the other things that is a fascinating trend that you may have heard of from Mike Volker when he talked about angel investing, but you wouldn't have heard about it last year because it wasn't happening. Angel investors, they're a little bit older. They're typically my age. Not so good with the social networking. They're kind of slow, but they're getting it now. And what's happened just in the last couple of years is that there's a platform for angel investors to share information on companies that they're investing in. It's called AngelSoft. You can get onto it. You can put your company up on AngelSoft. And what's happening is that there's an association in the United States that I belong to called the Angel Capital Association. And they put money into training angel investors in America and in Canada. Many of you have seen the announcement from the Vancouver Angel Forum that's run by Bob Chatworth-Musters. Bob often hires these American presenters to come up from the Angel Capital Association's education arm and puts on seminars. And it's how angel investors are learning. And one of the things that they've been talking about is angels in groups investing together in companies. And I'm on the executive of the Bellingham Angel Group, which is a pretty young angel group. It's only 5 years old. Just Bellingham. And you wouldn't think there was a lot of money in Bellingham. But it turns out there is an enormous amount of money in Bellingham. And the angel group there has cut off the membership at 50 because they can't get more people than that into the room. And these aren't 50 guys who are just hanging around. These are 50 serious investors. In Bellingham, we're talking about throwing people out if they don't write checks, just because we don't want to have anybody who's just a hang-around kind of guy. We want serious investors. And what's been happening just recently, especially south of the border, is that the smaller angel groups in places like Bellingham, and we work closely with the guys in Boise and other places like that, there's money, lots of money in those places. And there's lots of people that are sort of boomer age people that are getting to the stage where they want to make angel investments. So what they're doing is they're using this social network, AngelSoft, to collaborate, to share information on due diligence. And all of a sudden, what we're seeing is a couple of things. One of them is that they're investing across the border. About a third of the things that I end up investing in, a third of the things that Bellingham invests in are actually from Canada. It's a very healthy new phenomena. At a time when the venture capital industry is collapsing, what we're seeing cross-border investing primarily from angel investors, which is excellent news for us Canadians. And what these groups are doing is they're regularly putting $5 to $10 million into individual companies. Not just in one round, but over a number of rounds. Angels today can easily put that much money into one company. And if you look at the statistics, that's enough for about 99.9 something % of companies. So there's maybe one company in 1,000 that needs more money than angel investors can put together today. A fascinating new change, and it's part of the reason that you're seeing the venture capital industry in such a crisis. So what I came here to talk to you about was what this means to you and to your companies. And what I wish, even though I will admit this does not happen most of the time, what I wish for your companies, what I wish I had done, what I wish the next generation would do, is to build a company by first figuring out what kind of business you have. The most important question of all, understanding the type of business that you're starting. Then to build alignment amongst the team on an exit strategy that fit that business. And then to develop a financing plan. And then to start to contact investors if you actually need investors. If we could just get that methodology working in our startups today, I think we could double the success rate. It would be phenomenally powerful if we could do it that way, because that's the right business process. The reason is that when you build a company, as lots of you have already started to do, you know that when you start out, there's personalities, individual personalities. And when the team gets together, you sort of get a resultant corporate culture, which is like the group personality of the founders. And so it's a little bit like, I think, combining the DNA of the founders and ending up with a hybrid organization that's got the combinant DNA of the people that were involved in it. And that's a good, healthy process, and that's why teams are better than individual entrepreneurs. But what happens when you look at adding investors' money is you also get their DNA. And so what you're doing with your organization is you're adding in some often very different DNA. And you're combining that and ending up with a corporate hybrid that lots of times doesn't survive because that DNA wasn't compatible. And the reason I like this analogy is that we all know that when you make a mistake with DNA, it's very hard to undo, very hard to fix, and the result is usually not very pretty. And that's what happens when you mix the wrong kind of financing with your company. And that's why it's so vitally important that you've got to understand the exit, because different types of sources of financing are compatible with different exit strategies. If the Club Penguin guys, for example, had raised money from, let's say, Ventures West, they would not have been able to do that exit. For a high probability, it would not have happened. But more importantly, these $10, $20, $30 million exits almost certainly would not be possible if you've accepted money from a traditional venture capital fund. Because they need to put in a certain amount of money, they need a certain return, and they will always be the ones that make the decision because of their investment agreement. So what happens a lot of the times is that if you make that mistake early on, you won't know maybe for 5 or more years, but it can create a fatal and unrepairable flaw in the structure of the organization, which will often, as it did in my case, potentially cost you the entire corporation's survival. Not just its success, but its survival. The question in the back there.
Thank you. So I mean, we're into our first year. Sounds like we should start approaching some buyers relatively soon. How do you get on that initial radar of a Google or something like that? And then how does that communication pattern go over that, those 18 months? That's my favorite question. And I think if I answered it properly, the audience would lynch us both, because it's not a quick answer. There's a great one-day seminar I can recommend. The short answer, though, to be serious for a second, is this is not something you should try and do yourself. It's not something you can find a checklist to do. In 99% of the cases, the right answer is to find the right professional to help you. And I'd be happy to give you some more specific suggestions. In this town, there's some great people who do that kind of thing. It's not something you should try and do yourself the first time. If you want to know why you shouldn't do it yourself, and thank you for setting up my next point. A couple of years ago, I was asked to give a talk to the local entrepreneurs organization. And they wanted to hear war stories, because that's the most interesting part of business learning when you get to be, later on in your business career. You want to hear what the other guys really did. So I summoned up a whole lot of courage, and I told the story for the first time of how I almost blew my own first exit 3 times, and how I did lose several $1 million by riding it over the top. And that video, which is titled "Don't Blow the Biggest Deal of Your Life," is by far the most popular video on my blog. And if you ever want to know why the CEO shouldn't sell the company and how not to make the mistake that I made, I think that might be a useful educational resource. So how do you do it? To be more serious about the question, I think the most important element in your business plan is the exit strategy. And so if you want to actually sell your company, you want to start off and build that into your plan. And I think that every company actually does have an exit strategy, even if nobody realizes it. And even if for example, let's say you have a company and you never want to sell it. That's an exit strategy. The exit strategy is you die and somebody in your will gets those shares. It's a perfectly good exit strategy. Lots of companies in our fathers' and grandfathers' time had that exit strategy. But you need to have more clarity than that today, because the exit strategy will affect decisions you make every day. If you really do want to sell your company to Google in 2 years, things would be different than if you wanted to leave those shares to your children. You'd make different business decisions. And if you don't know which one you're doing, you can't be optimizing the outcome. The exit is just another business process. And most of us know that whether it's a financing, product development, marketing, or sales goal, that the chances of success increase dramatically when you've got a good plan. And every plan has to start with the goal. So the exit strategy for your business is that goal. It's the plan for the entire business.
My question gets more relevant the more slides you put up, so I'm going to ask it now. Is it possible to be flexible to multiple exit strategies? Or is it a strategy or bust?
You can be. It's hard, though. If you're trying to operate something with multiple targets, it's much harder to do a good job than if you have a precise target that you can get the whole organization to drive towards. But sometimes you don't know which the target is going to be best, so you do have to sort of head in the general direction. And so, in theory, yes, but in practice, I would hope that you could develop a clearer exit strategy early so that you'd have a better chance of aligning the team on achieving the goal. And it doesn't have to be complicated. The exit strategy can be as simple as our exit strategy is to sell the company in blank years for blank dollars. That's an actual exit strategy that I took from it's actually the Parasun case study. It's up on my blog as well. Local New Westminster company. We sold it for $15 million in 2007. Their exit strategy was to sell the company in about 2 years for $10 million. That was all they needed to create alignment amongst the team, the board, and the shareholders around that goal. You can make it fancier. You can add things like, we plan to hire a mid-market M&A advisor by blank date. But now, now you're getting fancy. All you really need is a clear goal, an idea of when, and a rough idea of how much the team would agree to sell the company for. Other exit strategies could be, especially in other times, an IPO or an RTO or something. But whatever it is, it's the thing that you've got to create alignment around. In every organization, success requires all of the members of the team to be working towards the same goal. And it's surprising how often I have come across situations where there's a serious misalignment amongst the key stakeholders on the exit strategy. And the only way to know that you've got a reasonable alignment is to actually get a sign-off. And I strongly recommend that every company has a written exit strategy. Take it as one of the retreat topics, get it written down, actually get people to sign it. And even after you've got that initial alignment, it's a good idea to have it sort of re-signed once a year. Because it's surprising how in just 1 year, people's perceptions can change, people's recollections will drift, new people will come in to the organization, people will leave, and the clarity around that alignment can drift. So what I've seen, and again, the most successful companies, is a clear exit strategy, written alignment. It might take more than one retreat to get that alignment. If the company is more than a couple of years old, it's surprising how people can have different ideas. But get that alignment and then keep it refreshed at least annually. So in summary for you, I think that the key points to keep in mind, most acquisitions are under $20 million, probably around 65%. I think 50% is about $15 million. That's the goal that you're shooting for if you're not leaving the shares to your kids. Modern companies don't need much capital. Most of the time when somebody brings the business plan to me looking for money, they don't really need it. Bootstrap, if you can possibly do it. It's by far the best way to build a company. Angels, if you need money, can go up to 5 to 10 million. If you need more, then you need venture capital. But the optimum exit strategy is to target an exit under $30 million. And today that can be done easily and regularly done in under 5 years. So to maximize your success, my hope is that you will start at the end. And that gentleman has the microphone.
When you say 20 million or 30 million, you're talking about revenues, gross revenues, I take it. Where does profitability figure into this?
Sorry, when I'm talking about 20 million, I'm talking about that's how much money you get for the company. So the revenue might be a lot less than that. In fact, a lot of times $20 million companies are getting sold for $20 million that have under $1 million in revenue. And oftentimes they aren't profitable yet. But what they have done is they have proven the business model. There's a business model with actual data, not a projection, but actual data that shows that it works down at the granularity of an individual client or individual customer.
Thanks.
Just while the microphone's working its way to the back, this last slide is I've got some resources that I've been working hard on that will help you with your exit strategy. I do have a book. A lot of the information in the book is available for free on my blog. And I'm working hard to get presentations like this in PowerPoint and, when possible, with video up online. This presentation, of course, will be online on the New Ventures website. So when it's time, or when you're curious, or when you want to do some more development, professional development, there's some things there I hope you find valuable. Sir?
I think, when you start a company, you're really passionate about that business idea, and you really put everything in. And when you build that company, it's like raising a child, right? You bring in the people, and you're really close to these people, and also that you have this distinct culture. So I think a company and when you talk about 30 days, 1 year, I think it's not a really company, right? You're talking a business model you're trying to sell, right? Am I correct?
This is the big question. And, you highlight very well my own evolution. Because when I was out of grad school, started a company. We actually started 7 companies, put them all together in one facility. None of us, not once, ever thought about selling. We couldn't conceive of it. We thought of them as our children. And it was an enormous mistake. And it was the first time that I lost several $1 million at once. I've done it quite a few more times. There's lots of lessons in life that cost several $1 million. But it was a mistake because we ended up waiting far too long to start the process. If we had been thinking more like investors when we were entrepreneurs, I think we would have started to sell much closer to the peak. And we probably would have sold the company for 2 or 3, maybe 5 times more money than we ended up selling it for. Because too often what happens is exactly what you suggest, exactly what I did, is we entrepreneurs fall in love with the company. We think of them like our kids, but they're not. They're just businesses. And yes, we can be very attached to them, but that attachment has a cost, often millions of dollars of cost. And if you have investors, they're not as complicated as entrepreneurs, and they just want to make some money. And there can be some pretty big disagreements if the entrepreneurs are in love with the company and the investors thought it was an investment. And so my goal, my purpose in life these days is to help entrepreneurs think about the exit in a better way than I did, so that fewer get to learn these lessons by costing as many millions of dollars as it cost me. Follow-on question.
Yeah, then if you think early and talk early, how do you prevent these big companies from copying your business idea? Because especially you are less than 1 year, the other guys think that your business model is good and what you're doing is good, and you give them all the details about your plan, and they can just execute on it. They don't have to even buy your company, right?
It's an excellent point. And it's if I had a whole day to do this seminar, and I do that regularly, one of the things I talk about is exactly that point, which is that, as I said, in business, stuff happens. One of the things that happens in business is big companies do steal ideas. A company that I invested in 3 times here in Vancouver was called Brightside. Brightside was a UBC spin-out that made liquid crystal displays higher contrast. And we sold that company to Dolby for $28 million in cash in 2007. And less than 1 month later, I went into Best Buy because I needed a bigger TV. I thought I already have lots of big TV. I wanted another really big TV. And I was looking at these models from Samsung, and they looked really bright, and they had really great contrast, just like the prototypes at Brightside. So I phoned up my friend in Brightside, and I said, it's the damnedest thing. They've got these really great new Samsung machines here. And he said, yeah, we went over there a year ago to see if they wanted to buy the company. And they signed the NDA, they took the diagrams, and as far as we can figure, they moved them to production that same week and started to build it. They never even thought about it. They just, ripped it off. And we were lucky. If Dolby had walked into Best Buy and it was a month later, because we didn't, none of us knew, but we never would have sold the company. Because, of course, now Dolby's in a 5-year-long patent battle with Samsung. And thank goodness it's Dolby, because that's their business, is, royalties from intellectual property. That would have bankrupted poor little Brightside, and I wouldn't have made any money on that investment. So yes, I think that one of the reasons you sell early is because one of the dangers is hanging around too long, the big guys will copy your business. So getting in, getting out fast, being agile is one of the things that startups can do. It's one of the reasons that the smart thing to do is think about whether your company might be a candidate for an early exit.
Yes. Could you elaborate, or do you have any examples on when you talked about your slide up there on the bootstrapping? Any good examples of?
Bootstrapping it's hard to describe. I mean, it's easy to describe in one way. What it means is you don't have any outside capital. There's no investors other than the team. You put your own money in. Maybe if you take a little bit of money from friends and family, it's still pretty much a bootstrap. But what it is it's almost a religious belief. It's a belief that you can build a company without needing investors. Lots of times it means you've got to find supplementary revenue models earlier on in the company's history. But what it means is you don't write a business plan, you don't submit it to venture capital funds, you don't go to angel forums and ask for money right off the bat. You only do that if you really, really need the money. And most of the time these days, unless the business is already to the point where you can prove the model, the VCs probably won't invest. Very, very low probability of success there. Even the angels want to see a business that's pretty well proven. Because these days you can build businesses for such a small amount of money that to ask investors to take the risk on an unproven model is pretty tough. I mean, it happens all the time. I do it myself regularly. But it's a tough negotiation. And you don't get a very good valuation, and you have to give up a lot of terms. By far, the best thing to do is to raise just a little bit of money. Friends, family, credit cards, do a little bit of consulting on the side, bootstrap the company, then get it to the point where you can prove the model, then make the decision, okay, we've got a couple of choices. We could either sell it now, maybe take $5, $10, $20 million off the table, or maybe we go and raise some money and try for a much larger exit. And the microphone's coming up right behind you if you want to use it. And our friends at home would appreciate it.
Never met a microphone I didn't like. Is it good strategy to stay with a company once you sell it, or is it better to just get out of the way?
That's a great question. The reality is that almost always the buyers will require you to stay with the company. One of the things that Charles Rim from Google was saying when he said that they preferred companies that were pre-revenue is that a lot of times the buyers put more value on the team than they do on the business that you've grown so far. And so almost always the buyers will require most of the senior team to come along and work in the company. Sometimes it's for as long as 3 years. When Greg Peet sold ALI to McKesson, he had to work there for 3 years to get the last 10% of the money. And when I sold my company to Scientific Atlanta, I had to go to Atlanta and commute back and forth for a full year. Yeah.
There's a lot of opportunities, as you were saying, with the internet now, and one approach would be to target a specific industry and try and fill a gap there. And you said the other people that are buying are mid-sized public companies. What do you define as mid-size?
The exits that are happening are, most of them under $15 million. And so what that means is that if the company has a value itself of 30, 40, 50 million, it's not that hard to buy something that's worth 5, 10, 15 million. So a lot of times the companies that are buying aren't even that much bigger than the companies that are getting acquired. So if you look at all of the companies that are out there that can afford to buy something for 10, 20, 30 million dollars, it's tens of thousands of companies. And it's one of the reasons that that part of the economy is working so well is that, when I look at where I might sell a company, it never takes more than a week to come up with 100 prospects that would be good buyers. Like if I spend a week, I think I could find 100 for any company. Because everything's online, it's very easy to find out who's in what business, who's been buying these days. And if it's a 10, 20, $30 million transaction, there's no shortage of buyers, which is one of the reasons it's pretty sure it's going to happen once you start the process. Sir?
Do you have to be careful about anything that you build into your company that would make it less attractive at the exit strategy, for example, licensing agreements or any other kind of partnering?
It's a very, very good question, and I'm glad you asked that, because one of the benefits of having an exit strategy that's clear at the beginning is it's something that you will use to affect decisions you make every day. And if, for example, you licensed your technology to Asia, for example, you've taken a whole part of the world and you've capped your upside in that part of the world by licensing the technology. That might be a great strategy if you're going to leave those shares to your children, because that's just a cash revenue stream that's going to come in forever. But if you're going to sell that, you've taken out a big part of the world as potential buyers, probably most of the world, because very few big companies would want to buy something where they couldn't capitalize on the world's largest growth market. So absolutely, you want to be careful with everything you do, that you are doing it in a way that will be a positive when you get to be thinking about the exit. The worst thing I see, the most common mistake, is to have employees without good employment agreements. Or worse, to have contractors without good intellectual property agreements. You know, a lot of times, you know, you're busy, you're trying to make the company survive. There's this great developer you can hire, and you only need him for a month to develop this little piece of code, and you don't get the best agreement about who owns that piece of code. Especially if this fellow is an expert in that kind of chunk of code, he might think that that technology is basically his technology. He'll probably start off offering you a non-exclusive license for it. But if that turns out to be a core part of your value, and you come to try and sell that company, you could be, a week from closing, and the buyer will say, "Oh yeah, we need to have clear title to that, all of the software. Please sign here to represent and warranty to us you have clear title." And if you try and put in there a small but, except for that chunk of code over there, everything will stop. And then you'll have to try and negotiate with that fellow. And I've seen that a couple times, and it's not pretty. So yeah, there's 100 things that you should do in your company. Half of them are just good corporate hygiene, but there's another half that are things that you should do if you're thinking about selling it. You'll end up doing at some point, but if you end up doing them at the end, it's going to cost you a lot more money, it's going to be a lot more stressful, and it impairs the probabilities of a successful exit. Other questions?
Yeah, a lot of your examples are software, internet-based companies, and I just wonder if you could comment how appropriate most of what you've said here is to a hardware company that would be making actual stuff. Like, would you still be suggesting the same kind of exit time frame, the same kind of exit values?
Yeah, I talk a lot about companies that are sort of online, because what's been happening is that this is a phenomenal time for that kind of company. And of course, there are still lots of hardware companies. There's still lots of enterprise software companies. But the comments about the internet, the comments about the economy are much bigger than the type of company. And so, yes, I mean, the internet has accelerated the development of hardware companies, accelerated their access to market, to talent, and to an exit. So yeah, it is pretty much the same. Where it is different is in companies where they have built-in very long discovery cycle, like drug discovery, for example. There's no way you can get a drug through the FDA fast. So if you're going to start a company and your goal is to discover a drug, that's a long-term proposition. There's no way around it. If you want to build a hydropower company, you're not going to bootstrap that. You're not going to get that done on friends and family money. That needs heavy investor capital. So again, other than companies that are of a different type, I believe that these comments are all generally applicable. Other questions?
Speaking of companies of that type, do you have any suggestions for companies that are in that area, say energy companies, et cetera, who need a substantial amount of capital?
Well, the thing about alternate energy, clean tech, green tech, that's good is there's lots of money out there. And it's kind of a hot area right now, so the entrepreneurs have the upper hand with the investors. So if you've got a company like that and you do need that much capital, if you're really sure you need $10 million to build something, there are lots of places to go for that today. They're easy to find. They're not easy to negotiate with, but it's easy to find the capital. Go ahead, just yell it out. I'll repeat the question.
What does that do for your exit strategy?
That's the rub. If you take $10 million from a fund, and let's say you do that at a $20 million pre-money valuation, because you have to have a pretty high value before you can get $10 million. So that means you've got a $30 million post-money valuation. If that was a Series A round, the smallest amount that a VC will approve the exit at is about $300 million. Because they need to make 10x on a Series A investment. That's how their business model works. The problem with that is that there's only, a couple of those a year in Canada. And there's only a couple dozen in America. So what you've done is you've put yourself in the category of what they call a moonshot. It might happen. It might work out. But you might win the lottery and you might get hit by a meteor, and it's long odds. It might work, and if that's what your goal is in life and at your younger age, I'd go for it. But just be realistic about your prospects for exit. And whatever you do, don't put any of mom's or your relatives' money into that deal. Sir?
I guess I have a kind of combined question. Is it possible or is it wise even, to combine a funding strategy with an exit strategy? So for instance, we're a hardware company. We have some extremely large competitors or potential competitors that could both fund the business and acquire it.
It's, again, a complicated business strategy question, and there's no short answer, but just a couple of broad generalizations. One is the same one I mentioned before, is that there's a very small number of big companies that will invest in an early stage company, who will take a minority stake. That's a rare occurrence as well. The danger with that, and especially when that was more popular, the danger that everyone appreciated was that you limit your exit options. Because let's say, for example, Big Co in your space owns 10% of your company. And you go to Big Co's competitor, and they're going to see pretty early on in the process that Big Co is one of your shareholders. They know right away that Big Co knows a lot more about your company than they do. They also know that Big Co could afford to buy you. So then either Big Co doesn't want to buy you, or you're just using them as a way to get Big Co to pay more. Either way, it really reduces your chances of success to have a strategic investor who otherwise might have been an acquirer.
Along the same lines as that question then, but maybe looking a little bit more strategically, if you're going to take angel investment in, is it a smart idea, or it seems like a smart idea, to try to get to have 2 or 3 of the angels somehow related to people or knowledgeable about areas who might buy you, your exits? So, for example, you have an exit A that you think is pretty appealing, but you want to create B and C options to increase the value. So you look for an angel that's related to C and an angel that's related to B, and they may have used to work for them, or they're kind of tied to them, or not on the board, but something which is kind of arm's length. And you get them involved. Is going after mergers and acquisitions expert a better call than that every time?
It's a great question. I mean, you answered half of it yourself. If you can find some directors who have contacts into the kinds of companies who might buy you, that's a great thing to do. But as you said, implicit in the other part of your answer was it's not actually hard to find buyers. And if you had somebody who worked at Cisco, for example, unless he was in the M&A department, he probably didn't have coffee or lunch with any of the guys that were there anyway. And for somebody who's a professional, to get into the right guy at Google, for me, it's an email, right? And for most people, and it's not that hard. It's not that I've got this super relationship. It's just that there's a team of about 25 guys there who all have inboxes, and they're just waiting for somebody to send them an email, because their job is to buy companies. Their boss measures them on how many companies they bought this quarter. So it's today, in this post-internet era, it's not hard to find the buyers. Are we done? I'll stick around if there's any more questions. Thank you very much. You've been a great audience. Good luck with your exits.